Stocks went up to a new 4-week high today, but then started to show a little bit more of the volatility. There are a couple of signs that would tell us that things might get a little bit dicey here. We might start getting a little bit more bearish. What are those signs? I'm going to break that down. I'm also going to break down a sector that's kind of coming back from the dead from recent moves, and with a trade idea and how we can take advantage of that with the rotation that's moving into that area. So let's go ahead and get started. Really quickly, but before we take a look at the S&P, I wanted to pull up my Twitter account again. At DavidSettle42 is my Twitter account. I always pin the market forecast tweet to the top. Look at this is amazing. In my first day back, the likes and the retweets and the comments I got, I really appreciate that. So I wanted to say thank you. And just a reminder, make sure you're following me. I will start putting out more stuff out there on Twitter again, like I was doing before. I'm still kind of working through some issues with Twitter on that. But if you find, I'm going to pin today's video up here to the top. If you liked it, let me know by clicking that like button. One-click feedback. It's a great way to tell me what you thought. And then again, if you think somebody else should watch it, if you would promote it and think other people should watch it, just click that. Click the retweet. That's all you have to do, and let Twitter do the promoting for you. And again, the comment section, what I'd like you to do is click that comment and let me know something you got out of the video today. Why you think it was worth it, why you think other people should check it out. One more thing too, on the survey, I mentioned a survey last night. And again, if you take a look at the video here, you'll see there's a link to the email list in the description of the video, so make sure you join that. And then there's the link to the survey. Really quickly, I had a couple questions on the survey. This first question, how interested you are in joining a company that we can create. Brandon and I can create. 10 is the most interested, 0 is the least. And the same thing on this one. When you rank these services in order of what's most important to you, 1 is the most important. So you just click in here, click 1, and then rank the rest of them down to 8. And then let us know what times are best for your classes. Let us know what tools you want to see on a website. That obviously we're not going to have all the tools right off day one, but me and Brandon are in this for the long haul. So we're looking to build out a solid website full of the tools that we like to use and we would use in our classes and share with you as well. So let us know what you think, and then let us know what topics you would like covered in those different trading rooms and classes, where we can connect with you on social media. And this is really important to us too. Tell us what you think. What would make the company the value, so valuable that you would feel like you need to join it to help fulfill your investing goals. So give us that feedback there and that question, and then your name and your address, so that we can keep track of you. Because those people who help us with the survey, we want to reward you, and we'll talk more about that later. But make sure you leave your name and your email address so that we can do that. And of course, click this done button when you're done, so everything gets saved and put in. Alright, well, let's go ahead and get started. Take a look at the market forecast to see what we expect to see going forward. The market forecast indicator, which is on this particular charting package here. You can see that we continue to have a strong bullish intermediate posture. A drop off momentum line, but not below 20. So we're not getting that bullish intermediate confirmation signal, where you have a oversold short-term sentiment combined with a strong bullish posture. Close, but not quite. The near-term line pulled back, which again would kind of dampen that signal anyway, because you'd prefer to have the near-term line below 50. It's been above 50 now for 8 days. Yesterday was 7, today's 8 days. But you do notice we're getting a little bit of a long upper shadow. We have to move this up, move up the near term. Here's the near term run that we're on right now, with potential retracements, and of course we have to move up the current intermediate run as well. You still got that 62% Fibonacci level lining up with the old highs, the previous intermediate high. So that's still an area there, and you can see there's other areas we've talked about in yesterday's video of support. You can see the 50% at that near-term high, this near-term high here. You've got these Fibonacci retracements, 38% lining up with that one. So there's a lot of support on any kind of pullback. So don't expect a precipitous drop, as there's going to be a lot of buyers lurking in the wings here and obviously down here as well. If we get that far, you're going to bring in a lot of buyers, because a lot of people are looking for any kind of pullback. And 100-point pullback on here, I mean, this would be a 4% drop, roughly. That we just haven't had that kind of a drop. That's going to attract. Usually, it would take like a 10% drop to attract a lot of buyers. Bring the valuations down a little bit. Not the case now. I mean, the way the market's been working this year, we haven't had 3% drops. So if we got a 4 or 5% drop, it will seem like the world is ending, but it will actually attract a lot of the quote-unquote smart money buyers at those levels. And hopefully bring that market sentiment line down, which at these levels really dampens down any kind of return expectations from today going forward. Of course, we had great returns up till now, but we can't go back. If you haven't traded that, you can't start today and go back and trade any of that return. You have to say, okay, what kind of return can I expect from today? And remember how past performance does not indicate future success? That's the reality. Just because we had that kind of return to get to this point doesn't mean we're going to have that kind of move from this point going forward. In fact, the odds are a lot less that we'll get that kind of move heading into this point, simply because, again, market sentiment's at 89. Versus being down below 70 when we were starting this move, and when you got the intermediate line below 50 versus 2+ months up above 50, heading towards that kind of mature end of its phase. Take a look at some of these other major indexes. Take a look at the Dow Jones Industrial Average. Let me mute the phone so we don't get beeped here while we're talking. Getting a lot of Royal Holiday messages of baseball pitcher that passed away in a plane accident off the Gulf of Mexico. Some of you baseball fans will really know that name through no-hitter in the World Series. So we'll just mute the phone there so I'm not getting bombarded with those kinds of tweets or notifications. Here's the Dow Jones. Looks very similar to the S&P 500. Again, look how long it's been above the 30-day moving average. Again, 30 days would be a 6-week moving average. You can see that's not typical without our test, and we haven't had a test since the beginning of September. So that is quite the extended move on the blue chip index. Take a look at the Nasdaq Composite, so not the Nasdaq 100, which is all those large caps, but the Nasdaq Composite. And you can see we did get a bullish intermediate confirmation signal, though again, near-term line is not below 50, so not the ideal scenario. We wouldn't say, hey, look at that. I mean, there's a dip right there. There's a pullback. Let's buy that dip. Now, granted, I mean, again, considering how the market's been behaving lately, maybe that is enough of a dip. But typical, according to the past precedent, again, we need to get that near-term line further into the lower half of the chart before we'd really take that intermediate confirmation signal seriously. I mean, obviously, there's a potential for a bounce simply because of that signal, but don't expect it to be longer than a day or two because the near-term line's already high. It's already up. It's already started the near-term run. And then finally, we'll take a look at the Russell 2000 here. Remember how the Russell 2000 was bearish here when the rest of the market wasn't? Well, again, we have the same scenario. Remember how the Dow is way up above its 30-day moving average, hasn't tested it for weeks or months? Not the case with the Russell. The Russell is breaking through old lows. It's got a bearish intermediate posture. Yes, its market sentiment line is high, whereas back here, we were kind of rising when we had that, and it slowly started to turn over. Well, we're kind of at that scenario again. Now, we're not getting extreme lows. We did over here on the momentum line, and that kind of precipitated this change. And it is a weak bearish posture, so don't read a whole lot into it more than that. But it is bearish, and it's really underperforming, especially the Dow Jones Industrial Average, which is not even close to testing its 6-week moving average. All right, now we see the long-term view, and again, continues to be very bullish. And let me just remind you, that's how high the 50-day moving average is above the 200-day moving average, just over 100 points. And you can see that here. The 50-day is at 25.50. The 200 days below the 24.50. But if I were to change that and change the MACD to show not the gap between the 50 and the 200 day, but the gap between the current price and the 200 day. And you can see here, we're starting to slow down a little bit, and for good reason. We're more than 150 points off the 200-day moving average. We've been that way before over here, and that led to that little weakness. and then we've been that way before over here, and that led to some weakness. So, so we're kind of in that mode where we're about as high off the 200-day moving average as we've been in the past with the S&P 500. And we're starting to slow down. Doesn't mean we're going to have, that weakness got to the 50-day moving average. Big whoopity-doo, right? That one got to the 50-day moving average and spent a whole week below it before coming right back up. So, we're not talking about like all of a sudden, the market's going to head down to the 200-day moving average, but there's a good chance because of how high the MACD is that we'll start to test at least a 50-day moving average, if not some of these other moving averages that we see on this chart, on the 3 green arrow chart. Of course, again, well up above the 30-day, and you can see if I were to take a look at the 2-line version of this, we're still even above the 8-day moving average. We tested the 17-day over here, closed 1 day below the 8, closed 2 days below the 8, and then got right back above the 8, and now been pushing up higher. But that the MACD is falling, slowly moving down. That's what it does. It doesn't dive down. It jumps up sharply, but it doesn't dive down sharply typically. Typically, it just slowly grinds from high levels. It will slowly grind back down to 0 before you really get the kind of the bigger moves. Now you notice I were to take a look at the Russell. Remember, the Russell's a little different. Oops. I don't know what I'm thinking there. I'm mixing up the index and the ETF. The Russell's a little different, remember, because it was already at that below the 30-day moving average. So we'll take a look at it really quick here. Here we go. So you see how this was moving towards the 30-day moving average this whole time. We were testing the 8. We were way up above the 8 for so long. The Russell had that strong run, and we were way up above the 8 for so long. Then we were testing the 8. Then we were testing the 17-day. We broke below the 17-day. Started to test the 30. Those two lines converged. Those lines converged on each other, and we grind. This MACD was grinding down to 0, and now we get the breakout move to the downside, where we can get this kind of a move here that leads to more weakness. And again, in August, when the Russell 2000 broke its 30-day moving average and broke through prior lows, the beginning of August, just as a reminder, the broad market during that same time, end of July, beginning of August here, the broad market followed through with some weakness later that month as well. So again, we're seeing it already, kind of in that leading small cap index. The expectation is that it should show up in this large cap if this past relationship follows through again. Alright, if we take a look at today's intraday move, you can see we did get a new 4-week high. So we pushed up to a new high today and pushed the 4-week range up higher too. But we also formed a lower low today. So after we opened up the day with that new high, we came back down to the old high, to yesterday's high, broke through it, broke through last week's high point, came down basically and met yesterday, went a little bit below it, but basically hit yesterday's low for support twice before bouncing off of it at the end of the day and clearing last week's high point. So some support in this area here at 258.25, touching a little bit below it, but again, don't read a lot into hundredths of a point. Basically hitting that 280. And remember, support and resistance isn't a precise hundredth of a point level. It's that range. In this case, it's around 280, 258.25, and it typically is a range around bigger numbers, rounder numbers, because everybody sees the same rounder numbers. Everybody sees, oh, it's breaking. Everybody's looking for 258.25. They see it breaking there, and they think, oh, and so it sucks in some short sellers here. And then boom, they get whipped out as that's kind of like a little bit of a fake out there. And you can see that round number held better at the end of the day because you didn't have as many short sellers thinking, well, they got burned the last time. They're a little more hesitant to sell and push through that support the second time. And for good reason. You can see the buyers came in right as soon as they got the 258.25. The buyers came in like they did over here and pushed us up to a new high, new afternoon high, not for the day, but at least a new afternoon high, and got to the middle of yesterday's range, the middle of today's range. So higher high, lower low, finishing in the middle of the range. Pretty neutral candle when you look at it from that standpoint. A bigger range. Because of the higher high and the lower low, a bigger range than what we saw yesterday. So 1.25 versus 3/4 of a point. The volume picking up a little bit more too, but still at around the average. 57 million. So we're right there at this average. 1.25 points is also a bit about the average too. And again, these are higher numbers than what we saw earlier in October when we were just kind of moseying along. So the volatility is ramping up a little bit, and you see that also in the VIX. Whoops, right here. You see that in the VIX jumping up to 10. You can see on the quarterly chart, on the hourly chart, the VIX jumping up to just about 10. Still, you know, again, you've got this kind of intermediary oscillators, both oscillators to the upper half of their chart. So there's kind of one big down move here from 13 down to 9. But you've got some sideways action here between what, 9.75 and 10.5. So that's, you know, that would be a lower high point. So we're not like too bearish here. But also remember too that the ratio between the VIX and the 3-month VIX. I'll have to go to a daily chart on this because they don't have the intraday data on this new 3-month version of this yet. Give it a second to load up here. There we go. You can see still below 75. So still extremely low ratio of VIX. So again, that suggests that we should expect the VIX to go up from this level. And again, if you look at the VIX on a monthly basis, we talked about this in October, that typically you get about at least a 4-point range in the VIX. Right now we're at less than a 2-point range, and the low is at 9, the high is almost 11. I mean, if we're going to get 2 more points of range, we're probably not going to drop to 7. We could, but most likely we're not going to drop to 7. So if we're going to get 2 more points of range, it's probably going to be up to almost 13 again, just like we saw in October. Where by the end of the month, after the expiration, we did get a jump in volatility to get up to 13 and get that 4-point range because we were so low for so long. So volatility is ramping up, and again, if we're going to get a similar move, you would expect that extra 2 points of range to come up here, more likely to come up here than it is to come down here. And again, a jump higher in volatility typically coincides with higher ranges, higher volumes, and falling prices. You know, again, like we talked about yesterday, there's lots of support. So we're not talking about plummeting prices. We're just talking about prices that are pulling back to areas of retracement, support levels where there's some retracement support there as well. Take a look at what's driving most of the price action here, and you'll see that the S&P, I mean, today it was a flat day. The S&P was only down 0.1% by the end of the day. At the lowest point, it was down a whopping 0.2%, maybe 0.25%. At the best of it, highest of the day, it was about 0.1% higher. So very, very small range, relatively speaking. You know, compared to everything else that you see here, a little bit bigger compared to itself, but smaller compared to everything else. You can see, look at the small caps selling off, emerging markets selling off, long-term bonds prices rallying. We saw with the here's the daily chart of the 10-year yield. If you take a look at the weekly chart, coming back down to that 50-day moving average after having gotten above, or kind of going up and down, up and down, up and down through both the 50 and the 200, because that 200 is just kind of flat. When these lines go flat, they're not really a support or resistance. They need to be trending for it to act as something. Right now they're both flat, so you're getting some ups and some downs, and we've had an up to 2.4%, and we're currently on a down right now for the yields. And you see that, and the dollar was up too. So I mean, those are your safe haven assets. Now the bullish dollar kept gold down. Gold did outpace some stock markets. Didn't outpace the S&P 500, but it outpaced all the other indexes: international, developed, international, emerging, and small cap indexes. You can see treasuries outpacing high yield. Crude oil still kind of hanging in there because there's those tensions that's going on between Saudi Arabia and Iran. Some tensions right now in the Middle East, and that's putting a floor, a little bit of a bid here underneath crude oil and pushing it up. But again, minus 2%. So and at the worst it was minus 6%. So this was actually a pretty low volatility day for what typically is the most volatile ETF on this list among all these different asset classes. If you take and there wasn't a whole lot of news going on today. You can see, JOLTS came out. That was the main thing. Janet Yellen spoke. Remember, she's kind of the outgoing Fed chair now. Eventually will be outgoing, but still obviously got some influence. But JOLTS is the main thing, and JOLTS continues to be very strong. This is the openings, job openings, turnovers, and layoffs. All the different, you have opening, you have separations, hires, and you have all different job cycles. And this is a very common indicator, a very popular indicator for the Fed to see, are there job openings or not. The more job openings there are, the more bullish the economy is. And you can see that we've been on a steady trend for a while, and we continue to hold up pretty strong. And that's showing up in, a still persistently strong Citigroup Economic Surprise Index, and also showing up in high expectations for a rate hike by the end of the year, which is practically 100%. And again, what we're looking at is that June for the next hike, right? Are we going to get another hike? And as we saw yesterday, the odds of another hike, the odds of no hike is 35%. So that means the odds of at least one more hike is 65%. And that's kind of split up between either one or two hikes. So if you take a look at the historical charts on this, we were kind of hanging in there, pretty decent odds that if we did get another rate hike next year by June, it'd only be one. But you'll see that the odds of a second rate hike, which is this, so here's the odds of no rate hike in 2018. One in December, but then not another one. And then you can see here are the odds of one rate hike next year. So that's kind of taken over. They were kind of battling each other whenever I stopped doing these videos in the beginning of October. Now that's taken over, but you also see that the odds of a second hike, which is still only 20%, but that's rallying here. So the odds of not having a rate hike at all is dropping down to 35%. So it's we're likely to get in one, maybe two next year because of how bullish this is, and because of this incoming Fed chair and the potential that there might be a little bit more orderly rate hikes to get back to a more natural rate interest rate than what Yellen has been doing. So remember how I said that the trading range for the broad market was 0.2% to the upside, 0.25% to the downside, so not very much of a range for the broad market as a whole. But that's not the case for all the sectors. You can see financials with the yields falling have been getting hurt, down 1% today. Consumer discretionary down a little bit. Even though Disney kept up, we talked about Disney yesterday, it started strong, pulled back, and held some gains today. But look at what outperformed. So those are outliers to the downside, energy as well. The outliers to the upside, safe haven sectors, utilities, staples, which had been struggling so much, and real estate. All of these areas, you can see healthcare there too. Remember, industrials and materials have been underperforming during this latest rally. They're outperforming a little bit, and technology, which is the momentum sector, still has some momentum, but it's that safe haven. This was a risk-off day. Now it was a doji day, from a candlestick perspective. We had a little bit of a doji here. Or spinning top, whatever you want to call that. But we also got a little bit of a longer upper shadow. And again, the more we get some longer upper shadows, and for that matter, longer lower shadows too, but more so the longer upper shadows, the more likely we are to start to get these pulled, if not just a near-term pullback, but at least an intermediate-term pullback. And we can see, obviously, again, where those support levels would be if we were to start to get that. Let's take advantage of the bullishness in consumer staples and take a look at Procter & Gamble for a bullish trade. Now you notice it held up. There's some support here at 85. That's where we kind of pulled back. Remember, consumer staples has been down 3% during this run, this bullish run by the market. So there's some value here in a stock like Procter & Gamble. There's obvious support at 85. We've had a good bullish kind of engulfing day today where we pretty much engulfed the last however many days here of candles. If you take a look at it here on an intraday chart, you can see it a little bit differently. You can see how we're getting up. We tested down. We got this long lower shadow we talked about that can be bullish. We're up here. We don't want to be too bullish now. We're not like we're gonna be speculative and directional and buy a call option. Let's get back to the 3 green arrows. But you do have, you know, the MACD is crossing up above its a 0 level, above its moving average. Remember that we don't typically grind up to 0. We typically make a stronger move up to 0 like this. We typically grind down to 0. And then the stochastics has been extremely oversold, has crossed up above its moving average as well. And again, we say, okay, well, we don't want to necessarily buy. We can sell a put at that support level at 85, buy a put to protect against any big downsides. Now I'm doing a lot of options trades because, again, remember that the market's kind of dictating to us not to be too bullish. The VIX is extremely low. The valuations for stocks are really high on a broad level. So from today going forward, if I'm entering new positions, I don't want to be aggressively bullish because that's not the market environment that we're in. So that's why I'm steering more towards these less directional options trades, to be able to add some return to a portfolio without being aggressive in an environment where the market's telling me not to be aggressive. Now again, if I'm basing potential returns off of past performance, then yes, I'm going to be super aggressive. I mean, we've been up, what, 20-30% over the past year? So yeah, shoot, I'll be super aggressive if potential returns were based off of past performance. But we know that that's not the case because every compliance department across the whole industry will tell us that's not the case, right? That past performance does not indicate future results. And the market doesn't tell us that, right? The market tells us to base our expectations on volatility levels and on valuation levels. And they're both at extremes in the area of lower return expectations. And so our strategy selection should reflect that, especially in an industry that's been beaten up, that's been outperforming today. And if there's any kind of intermediate pullback, then typically the market's going to be more risk off and would favor a sector like this that has that already has been beaten up. So it's not going to drop nearly as much as, say, some of these other really bullish sectors like the energy sector, the technology sector. They've had much stronger gains, so they have more to give up if there is any kind of risk-off move. So we'll sell that 85 put. We're not going to get a lot of return because, again, that's not the kind of market we're in. We're expecting a lot of returns. We're actually going to get smaller return than what we typically shoot for in a $2.50 wide spread, but it's going to show up in a higher probability of success. So we're giving up $34, and it also shows up in the fact that if we break $85, then you can see that my loss is only going to be about $50. Because if we break 85, let's say we get down to 84, then we're going to be about at a $70 loss, and that's not going to change much. You can see the green line, which is the expiration loss. That is the green line is the expiration date profit and loss. The purple line is that profit and loss for this day down here in the bottom right corner, which happens to be today. So if we get down to 84, we're going to lose about $70. I'm trying to make 34, so I can keep my loss relatively small. And we know that there's a low chance of that happening by expiration because it's above 70%. We'll say above it, and we also know that number is actually going to be higher because there's a strong support level. And when I say a strong support level, because there's multiple touches at 85. Here, and if I were to zoom out a little bit more, you can see just how strong this is on a bigger picture level. Here you go. You can see there's an old high point. Lots of buying and selling that traded hands here at 85 in that area. So there's going to be some very, very strong support at 85. And we don't have to worry about the earnings announcement for a while. So we can trade a smaller return because, again, it's a bullish trade, and we're in a mature bullish trend. And how much longer we're going to stay bullish, we don't know. So we're willing to accept a smaller return to go for the higher probability of success for this bullish trade. So to summarize, the market continues to be strongly bullish, but we're starting to see extremes in volatility, extreme lows in volatility, as well as a bearish moves and a bearish kind of breakdown in the small cap index, in the Russell. We also see safe haven rotation among different asset classes with a move into bonds and the dollar, as well as moves from a sector rotation into safe haven areas like utilities and staples. And today's trade idea focuses in that staples area. And remember, again, we're looking for a smaller return because of the maturity of the bullish trend. We don't know how much longer it's going to be bullish. And we also have a strong support level that we know if we break, we're out. We'll take whatever loss it is at that point and just get out. And that's imperative. If you're going to trade high probability strategies like vertical spreads, you have to be willing to take small losses and not wait and hope that they'll turn back around and get back to those small gains, because the last thing we want to do is take the big loss, because it takes a lot of small losses to offset that big loss, and we don't typically get a lot of small gains, small gains offset the big loss. We typically don't get a lot of small gains in a row, right, because this from an odds perspective. So it's going to be a while. It takes quite a few trades to offset a maximum loss if you're trading the higher probability strategy. So we know where that break even point, we know where our get out of town point is, and at that point you have to be willing to take the small loss in order to trade that particular strategy. Otherwise, it'll just hurt too much. So we have a way to take advantage of a maturing bullish trend in a sector where there's some rotation into right now. So thanks again for watching. I really appreciate it. And remember to fill out that survey. We're looking to try to get that 1,000 surveys. We're well on our way. Thanks to you. We want to hear what you want in an investor education company. Your input, your opinions and feedback are very, very important to us, as well as we'd like to know what you think about our ideas that we have. So again, in the description of this video, as well as on the channel, you can click on that SurveyMonkey link and let us know what you think. And as always, give me a thumbs up to let me know that you liked and found today's video useful. Quote tweet today's Market Outlook tweet and let me know something you learned from the video. So that said, thank you again. Have a great one, everybody, and we'll see you tomorrow.